All right, let's get straight to it. The date is October 28th, 2025. The market's at all-time highs, but the real action is violent and stock-specific. This is your numbers first framework for the current tape. First things first, the S&P 500 is printing new highs. The trend is your friend, and right now the path of least resistance is clearly up. Fighting this is a low probability trade, period. Momentum is strong, and there are zero technical signs of a major reversal. But look, just buying the index gets you the average return. The real alpha, and yeah, the real risk, is found underneath that calm surface. It's in the individual company stories. The money is made in the details. And this right here really shows you the core conflict we're dealing with. On the left, you've got the macro picture. It's calm, it's trending up, low volatility. But on the right, you have the micro. And it's a completely different world. It's violent. It's totally event-driven with these massive, high-volatility price swings in single stocks.
So the whole point of this breakdown is to give you a tactical framework to actually trade that difference. Let's dig into the key drivers so we can figure out how to position.
All right, Section 1, top market-moving news. We're going to cover what happened, why it actually matters, and what it's doing to the tape right now. Okay, first up, PayPal is gapping up hard. Why? A major AI partnership with OpenAI. This is a big deal because it could finally shift the negative narrative that's been crushing this stock. Then, over in M&A, Skyworks is buying Qorvo. This creates an absolute powerhouse in the radio frequency chip space, a $22 billion behemoth. UPS beat its earnings, which is good, but you look at the chart, and it's running right into a brick wall of sellers at the $96 resistance level. And hanging over everything, the government shutdown continues. This isn't just noise. It's a direct, quantifiable drag on the economy. So with the market at all-time highs, what could actually derail this thing? Let's zoom out to the macro risks and the volatility drivers to get that 30,000-foot view. The VIX is sitting at 15.5. This is the market's so-called fear gauge, and right now it's signaling total complacency. Now, on one hand, that means it's pretty cheap to buy protection, but a coiled spring can snap hard. Remember, low volatility is not the same thing as no volatility. Now, on the bullish side of the ledger, look at copper. It's up 21% since early August. They call it Dr. Copper for a reason. It has a PhD in diagnosing the economy's health. This surge is a really strong leading indicator for both old-school industrial demand and new-school AI data center demand. But here's the counterweight. The primary macro risk is that shutdown. Multiple analysts agree that for every single week it continues, it's shaving about 0.1% off GDP. This isn't a guess, it's a real-time economic headwind we have to price in. Okay, so with that macro backdrop in place, where are the actual opportunities? Let's drill down into the corporate catalysts that are creating the most action right now. Now, before we even look at a single setup, we always start with risk. The next few ideas are high risk, high reward. So the first, and frankly the most important question you have to ask yourself is this: does the potential reward justify the very real potential for a total loss? All right, two names are lighting up the scanner for a potential short squeeze: ABCL and NBTX. The thesis here is simple. You have exceptionally high short interest running headfirst into near-term catalysts. For ABCL, it's a string of conferences. For NBTX, it's a business update. But let's be crystal clear, the warning is right there on the screen. There is a very high probability you will lose 100% of your premium on long options here. This is a lottery ticket, not an investment. Size it accordingly. Okay, now for something completely different. A more conservative idea in waste management. The stock took a hit after earnings, and you can see the result right here on this chart. Its current forward PE is 26, but its 5-year average is 28. That dip created a rare discount, and it happened right as the stock came down to test the huge psychological support level at $200. The thesis is a simple mean reversion play. And over in healthcare, this chart tells you the entire story for UnitedHealth. Their number one problem is margin compression. Historically, as you can see on the left, they operated around an 8% margin. Right now, they're down to 4% because costs are just soaring. Management says they're fixing it, but they've been very clear this is a multi-year turnaround. So we have a high-risk squeeze, a value play, and a long-term recovery story. Before we assemble this into a full framework, here's the mandatory disclaimer. This content is for educational purposes only. It's aggregated analysis from multiple public sources to help you stay informed and improve your own decision-making. Do your own research. This is not financial advice.
All right, so how do we actually put all these pieces together? Let's build a clear framework for how to position in this market with very specific scenarios.
Here are the 3 scenarios you need to watch. Your base case. The market keeps grinding higher, led by these individual catalyst stories. The posture there is to stay long delta, but use tactical, defined risk trades and hold a good amount of cash. The bull case gets triggered if we get a quick resolution to the shutdown. If that happens, the plan is to increase delta exposure. And then there's the bear case. The shutdown drags on, the VIX breaks above 20, and our key catalysts fizzle out. If you see that, the plan is to immediately reduce delta, add hedges, and raise cash.
So it really just boils down to this. The bull thesis is that the strong uptrend and these positive microcatalysts like the PayPal deal are powerful enough to just muscle through the fiscal drag from the shutdown. The bear thesis is that the shutdown's economic damage becomes too much to ignore, the speculative plays like ABSCL fail, and that combination triggers a broad, risk-off move that sends the VIX screaming higher.
Now, let's talk tactics. How can we use options to structure trades around this framework? Here are 3 non-advisory ideas that line up with our analysis. Okay, first, for that speculative ABCL catalyst, a long call debit spread. You're buying one call and selling a higher strike call against it. This caps your max loss to the premium paid, which lets you play for a sharp move with strictly controlled risk. Second, for the waste management value thesis, you could sell a cash-secured put at the $200 strike. This does one of 2 things. It either generates income if the stock stays above 200, or it lets you buy the stock at your target price. And third, for UNH's long-term story, a long-dated call spread, or a leap spread, lets you participate in that potential multi-year recovery, again with a defined risk position. So, the framework is there, the potential setups are on the table, but the most crucial question isn't about predicting the future, it's about having a plan. What's your entry, what's your target, and most importantly, what is your invalidation point where you know you're wrong? Answering that is what separates trading from gambling. And let's end with the final disclaimer. This is not trading advice, just a market update to keep you informed. Markets carry risk. Trade your plan, manage your downside, and verify all data.